All right. Welcome back to our live video streams here. So, my name's Laura Vang. I am a realtor as well as a loan officer based in the Milwaukee, Wisconsin market here. And I'm joined today by Johnny Vang. He's also a realtor as well as a loan officer as well. So we're here just to share a little bit more information, right, with you guys. If you have any questions related to buying a home, anything like that, feel free to drop it in the comments as you join us here. Today, right, we feel like we should probably just start with the basics, right? There's a lot of people out there that, may not have ever bought a home and they're thinking about it, right? How do you get started, right? How do you know how much home you can afford? Or that whole process, right, of getting a pre-approval. So that's what we're going to be talking about today. So let me bring in Johnny here. Johnny, feel free to introduce yourself.
Yeah, this is Johnny Vang, loan officer realtor in Minnesota within the Twin Cities. I also have my loan originator's license out in Florida as well. And so if you're looking to do business anywhere between Florida and here in Minnesota, we should be able to assist you. We also have teams, right? So the team members can also assist as well. Um, yeah, so that's a little bit about me. I've been doing this for a pretty long time. 20 plus years in mortgage and then 15 plus years in real estate. So, yeah, we're just here to talk a little bit about the pre-approval process, right? So, thanks
Yeah,
for having me.
so yeah, of course. So as far as your 20 years experience in lending goes, right? It's there's a lot more to it than just being a loan officer. You've done quite a few roles. Can you kind of just share a little bit about what roles you've been doing in loan?
Yeah, so I started off in the early 2000s as a paper pusher. Um, Slowly made my way up through processing, closing, underwriting, eventually leaving the banking industry. So went from Wells Fargo to U.S. Bank, and eventually leaving that industry while I was the wealth management supervisor of U.S. Bank, and so it was super cool gig, super cool people that I was able to work with. Learned a ton along that process, and then eventually moved out and became executive vice president of a mortgage brokerage. Did super well with them as well. Great people again, and then decided to finally just go ahead and start my own mortgage brokerage. So I did that about, I would say, about a year and a half ago, and haven't looked back since. It's been an amazing ride.
All right, awesome. So, yeah, I mean, you've done a number of things, from the busy work, like you said, to the loan officer thing, right? So you're the person to ask. You know pretty much the loan process inside and out. So we got a pretty, pretty unique perspective here today. So just wanted to give you guys an idea of Johnny's experience, and he knows so many things that it's just normal to him. And so it's like, um, you know, I have to ask him the questions, and then he's like, "Oh, okay, you mean that? Yeah, that's simple. It's like this." Um, but okay, so the first thing, right, when somebody wants to buy a house, right? Um, right, one of the first questions is like, "Hey, how much home can I afford?" Right? So,
Mhm.
how would you help somebody can you explain the process? How can somebody kind of calculate or them for themselves, or how would you calculate that for them?
Yeah. So, how much you can afford depends on a couple of things, right? I mean, at the end of the day, it's qualification from a lending perspective. Um, you would start out with the debt to income ratio, find out how much money you make on a monthly basis versus how much do you spend. You're looking at calculating debt to income ratio, which means you're going to take all of your debt that would be reported on a credit report, and then you're going to divide it by your income, right? And so whatever that ratio comes out to be, as long as it's under 50%, the likelihood is you're going to be able to qualify for a loan. And then the rest is like some nitty gritty details depending on what it is that you have going on.
Okay. And then, can you describe the pre-approval process? What does it look like when somebody applies for a mortgage application?
Yeah. So when you apply for a mortgage application, you're going to be sending in a ton of information, your identification information, um, from name, phone number, social security number. They're going to be doing a credit check, right? After the credit check, they're going to be looking at your income documentation, your asset documentation. So you're going to probably have to send in 2 months of bank statements, about 30 days worth of pay stubs, and the last 2 years of W 2. If you're self-employed, you'll be sending in tax returns along with any K-1s or any business tax returns. So underwriters as well as loan officers are going to be looking at all that to try to determine where your income is, as well as where it might be going. Usually, we want 2 years of work history just to see that your work is stable. And school can be utilized as work history as well, right? So if you went to college and you majored in becoming a pharmacist, and that's what you ended up doing is becoming a pharmacist, then we can use that as work history.
Got it. Okay. Okay. So let's talk about credit scores real quick. Um, what's the minimum credit score? Right. What
Yeah.
are the
So
different things?
A minimum credit score would be like 580 with no current late payments, right? Usually we want to see something like a year's worth of credit without any late payments. That 580 score will get you into the government programs, which is the FHA, VA type products. Where I think right now the FHA, VA interest rates are uh, lower than the conventional interest rate. However, there's additional fees that you have to pay, like upfront MIP fees, as well as larger insurance or mortgage insurance fees. And so, if you want to go conventional, usually my company requires that you have at least a 620 FICO score with no late payments in the last 12 months. And the honest truth is that in the last 2 years, if you have like a 90-day late, the likelihood of us financing you is going to be a struggle. So um, we'd probably recommend you clean up your credit as much as possible. I think the best credit score to have is 750, but if you're above 680, you're probably going to be just fine.
Right. Right. Okay. You mentioned MIP, right? Mortgage insurance premium for FHA products, right?
Mhm.
Something similar, right? PMI, right? Private mortgage insurance for conventional loans. But essentially, it is an insurance, right, that protects if you, the borrower, default on your loan. There's an insurance that protects the lender, right? It's not going to protect you, sorry, right? If you can't pay your mortgage, it's going to pay out the lender, but it won't cover you. But, one of the biggest things, the misconceptions, a lot of, kind of just out there is that, oh, you shouldn't buy a home until you have 20% down, right? Um, the biggest thing is with conventional loan, if you put less than 20% down, you're going to have to pay the PMI, right? Now, in your opinion, should you wait until you have 20% down, or should you just go ahead and buy and know that you're going to have to pay that PMI or the MIP?
Lenders have a bunch of different products, right? And so I would recommend that you go ahead and pay that MIP and talk to a lender and find out what you qualify for. Say, for example, you're a veteran, right? Or if you're not a veteran, but you're active duty inside of the military, you have the ability to use some VA benefits. And that is usually a 100% financing deal, right? So the only thing that you can't finance is the closing costs, which then sometimes if you talk to a realtor, you might be able to roll in those closing costs. So you can, if the seller pays for it, right? When I say roll in, I mean seller's paying for the closing costs. If the seller's paying for the closing costs and you get 100% financing, there's a possibility you're coming to closing with nothing, right? And so I would recommend you jump in, especially during these times where home prices are continuing to increase. And I think what we've seen is that for the foreseeable future, home prices will continue to increase just due to population itself.
Right, right. So that's very important that you know, if you keep trying to save, wait until you save that 20% down, right? It might take you 5 years, right? Versus if you already have say the 3%, right? And you could buy today, well, you're buying at today's price, right? If you wait 5 years later, that price might be all the way up there, right? So that's very important. And then just to give you guys a scale, right? How much is PMI compared to your mortgage?
I would say it's a percentage of the mortgage. So I'm thinking, and it depends on which lender you go to. It could be anywhere from zero, well, not zero. It could be anywhere from like 15% all the way up to like, I would say 50%, or maybe not 50%, but like 25% of your monthly payment, right? Approximately. So you're looking at a pretty decent amount on a 200,000 $250,000 loan. It could be anywhere from like $100 all the way up to like 250, right? So you're
Mhm.
gonna want to look at that closely to see your affordability scale. Of course, your loan officer is going to tell you, but the honest truth is that you need to measure your own ability too, because what we don't know as lenders is we don't know your spending habits. We don't know if you like to go eat out on a consistent basis, and if you want to continue doing that, you have to budget that in so that we're not, you're not like house rich and uh poor in general from a perspective where you're trying to make ends meet on food, right? So
Right, right. Very good points. Yeah, yeah. So I mean, from what I've seen, like you mentioned, like a 200, $300,000 house, your PMI payment might be, $100 to 200 some bucks in that range,
mhm.
on top of your principal and interest, right? So not too terrible, but there are some tricks to getting rid of PMI quickly, right? Such as maybe doing a refinance. If the market goes up, your equity goes up, you can refinance that early. Otherwise, the normal process is the PMI does fall off after what, 78% LTV, 80%, right?
Yeah, so actually, the PMI only falls off on conventional loans, right? They don't
Correct. Yep.
fall off on government loans. But when they do fall, they fall off when your loan to value is about 78% of the original purchase price, right? So if your home increases in value in the next 2 years, you're gonna have to do a you're going to have to reach out to the servicing department to have them take a look at it with an appraisal. The likelihood is that you're going to have to pay for an appraisal. But if you don't do anything at all, right, and you just simply wait, once your loan falls to 78% of the purchase price, you're going to see the mortgage insurance fall off.
Right, right. Okay, so that's that handles the PMI question, MIP question. Um, and MIP again is it's only for FHA loans. PMI is for conventional loans. With FHA, MIP stays for the life of the loan. Okay, the only way to get rid of it is to refinance out of the FHA, um, which you could do that later. Now let's talk about income, right? Let's talk about the different types of income, which is something interesting that. So I'm a newer loan officer. I'm only 8 months, 9 months in, but it's always interesting to learn along the way that depending on what type of occupation you have, the way your income is calculated, right? It's pretty interesting, right? Can you talk about, what if you're an hourly worker and you make overtime? How can you get overtime counted?
Yeah, so I'll just touch base on the W-2 type income, right?
Sure.
So when you're working a W type income and you get a 40-hour week, basic, consistent income, there's nothing changing, and every week you do your 40 hours, your income calculation is pretty easy, right? It's just your monthly income, whatever it is that you make on a monthly basis. That's what we're going to use. However, if you have overtime, in order for us to use overtime, you have to have a history of 2 years of overtime and the likelihood of continuance in overtime. Say, for example, if you are in a workshop and you're as a machinist, right? For example, and because of the lack of machinists out there and to this current day there's still a lack of machinists, you're working, let's say, 5 hours of overtime every week, and that's pretty consistent throughout the last 2 years, and your employer verifies that it's likely to continue for another year, right? Where you're going to be able to use that overtime income to be added in. Now, if it's inconsistent, we might be able to average it if you got a 2-year history, as long as we think that, the income's going to continue. And then, for W-2 people who have variable income, right? Then now we're averaging those as well, right? So let's say, for example, you are a nurse, right? If you're a nurse, you have variable income. And that means that, sometimes you might be on for 4 hours one day. Sometimes you might be on for 16 hours one day. And the payout could be various, right? You're going to have anything from emergency pay to night shift pay to, I mean,
Mhm.
you name it. Like nurses just have so many different types of pay that they've received, depending on the field that they're in. And so when you're looking at that, if the income is consistent, like if you get 40 hours a week and that's consistent throughout the last 2 years, then great. But if not, if your hours are all over the place and it's really, really hard to read your pay stubs, what we'll do is we'll take an average of the last, uh, the year to date plus the last 2 years. And so the likelihood is that your income would have increased over time. However, we can't use the full amount. We can only use an average, simply because we don't know if your hours are going to be reduced at any point in time, right? So you're going to see us calculate variable income, and nurses is just one of them. It could be something different, right, with a different position that also has similar types of pay with nurses, that you're going to see us average those types of income. And then um I think that that covers the majority of how W-2 earners actually get paid. There are a few that are like, if you're part-time, you're going to be averaged as well, right? So there are going to be some clients that come out their W-2 and they only work 26 hours, maybe 32 hours a week. Your income is going to be averaged as well.
What about bonuses? If you get paid
Yeah,
bonuses?
bonuses is the same as overtime, right? So you're gonna want to see 2 years history of bonuses.
Mhm.
You're gonna have to provide either the previous year to date pay stubs to show that you did receive bonuses for the last 2 years, or we're gonna have to reach out to your employer and get what's called a verification of employment and
Mhm.
determine in the previous years, how much of that income that you received is bonus or overtime or something else, right?
Right. Okay. How about our favorite, right? Us 1099 self-employed people, or you run your own business. You want to buy a house. What does that look like?
Yeah, so usually you want to see so if you go to the local banks, right, as well as to if you want a conventional program, you're going to be looking at needing a 2-year history. And when that what that means is 2 years of tax returns history, 2 years of income that's been reported. And some lenders may ask for profit and loss to see how you're doing in the current year, but in most cases they'll go ahead and they'll average the last 2 years of tax returns to determine where your income is. So let's say, for example, like realtors, right? I think realtors is a really good example because they go from making in the first year, they might make, I don't know, 30,000. In the second year, they may make like 90,000. And
Mhm.
then in the current year, they may make below 90, or they could be making way more, significantly more. We're going to be averaging all of that. So your 30-year, your 12-month, 30-year, no, 30,000 payment is going to be included, and so we're going to be averaging that out. Again, we don't know how your business is going to go, so we have to take an average of the last uh 2.5 years or 2 years plus the year to date, right?
Yeah. So, what about so the income you're talking about as a self-employed though, is that gross? Right? Is that gross income or is that
Yeah, no, it's not.
after?
It's
Okay. So let's clear that
it's
up a
your
little bit.
net.
Let's clear
That's
that
your
up
net.
because
They might be able to add some depreciation. They might be able to add a few things back in, but
mhm.
it's your net, right?
Okay,
With
okay. Yep.
with W-2, we're using gross, and with self-employed, it's your net. So if you write
Okay.
everything off, you're I mean, you're not going to be able to use that as income.
All
Um,
right. That's exactly what I'm trying to clear up for people here.
yeah, yeah,
So if you made 100K gross, right, but you wrote off, say, 75,000, and on your taxes it says net earnings 25,000, we're going to use that $25,000 as your income, right?
yep, yep.
Uh, so if you're planning to buy a house, be very careful on how much you want to write off, right?
Yeah, pay the taxes.
So that's one of the biggest challenges that I've experienced, that I've seen when I'm trying to help self-employed people. They don't quite understand that. Oh, but I make like 150, 200. But wait, your net says you wrote everything off and you only made, 50 or whatever, right?
Mhm, mhm.
I can't get you a house for that, right?
Right.
So, okay. All right. So, did we talk about DTI yet? Calculating DTI? Did you explain that?
I kind of breezed over it.
Okay.
But in detail, right? In detail, you're going to be everything that shows up on your credit report, right? So you're going to be looking at your um all
Mhm.
of your debt that like such as your credit cards, your auto loan, your student loans. Even if your student loans are deferred, we have to include a payment, right? So we usually include if they're currently deferred, we use 1%, right, for qualifying. Um, you're gonna have to include a bunch of different things. Something that is not on the credit report that we have to include is child support, right? So we're going to be looking at adding all of those things into the amount of debt that you have in addition to the new house amount, right? So whatever the new house is plus taxes and insurance, you're going to be looking at all of that, and that's going to be all included in your debt to income ratio. That's the same as if you have rental properties; those payments will be included in your debt to income ratios too, unless you file the rentals on the Schedule E or in one of the businesses or something like that. You're going to see that debt added on, and it's going to be included into your debt to income ratio, which again is your debt divided by your income, right?
Mhm. So if you have things like rental income or some other type of income, right, like Social Security, something like that, how is that? Do you get to claim 100%? How does that account for?
You said your Social Security.
Yeah, like some kind of benefits, right? Some, that you would get some type of income for, right? Like your rental property, right? If you own a rental property, can they count 100% of that rental income, or is it slightly corrected?
So how they do it, if you own your property for more than 12 months, they're going to take the bottom line. They're going to add back in depreciation, and then they're going to take out the debt to see if you still have any income left over. Say for example, if your monthly payment is 1,500 and your expenses are 1,500, and that doesn't include depreciation, you will get no income from that property.
Mhm.
But if if you do have income, they can use 100% of what's on the tax returns. However, if you don't have a year's worth, then they're going to use 75% of what the rent is. And so you're going to have to provide a copy of the rent, maybe 2 months of history, or a security deposit plus, the first month rent. You're going to have to show that documentation to be able to try to exclude anything or add in any kind of income from any rental property. When it comes to Social Security income, sometimes depending on your tax bracket and your tax benefits, you may be able to use like a little bit more than 100% of that amount. We may be able to add some more into it, but usually when you calculate it all out, it's not significant because we need your tax returns, and most people, the it it doesn't give you much benefit. If anything, maybe they can add back in like about 10% is what I'm seeing on average.
All right. Okay. So, what about things like cell phone bills, utilities? Is that a debt?
Yeah, so cell phone bills and utilities aren't normally included. However, if you're doing a VA, they do a residual calculation, which means that you have to have so much money after you pay off all of your debt. And they do include some utilities in there. They do include some child support, or not child support, child care type information in there. And so in order to meet the residual, they might add those. But if you're just talking conventional and FHA, then yeah, we don't include any of those bills. So you're going to have to account for that yourself.
Got it. Okay. Um, and now one of the biggest debts that we see when we're reviewing most applicants is car loans.
Hmm.
Um, Now, what if your car is almost paid off, right? Can you explain at what point, right? Do they count it? Can they not count it? How does that work?
Yeah. So if you have a loan, like a close end loan, whether that be a student loan or whether it be an auto loan, if it's a close end loan, meaning you can't, it's not like a credit card where you can draw from it again. If you've got less than 10 months left, or 10 months or less left, you're going to be able to exclude it from your debt to income ratio. However, like you got to be careful with that, because you know what, I laugh about this all the time, and in our community we see a lot of people pick up brand new Tundras, and when they do, that just throws their ratios into like the trash, right? So you're going to want to watch how you do things. A lot of people, after they pay off one car, they might think about buying a new car, and you're going to want to talk to your loan officer before you do something like that.
Yeah, definitely, definitely. I've lived that tundra story, so that's why I'm kind of laughing over here. But yeah, yeah. If you plan to buy a house, don't buy a car first. Okay? Wait to buy that car after the house. Okay, if you can, right? What about leases? Leases is a interesting thing. What's your take on that?
Yeah, so a lease is not like a auto loan where you take it out and then you pay it off and you keep the car. When a lease ends, you have to give the car up and you have to get a new lease, or a new car. So they're not going to take a lease off your debt to income ratio. You're going to see them leave it on there, even if you only have 10 months left of payment, because they're assuming you're going to go pick up a new car and start a new lease.
Good point. Good point. Yes. So if your lease is coming up, and they're not going to be able to exclude that lease payment from your DTI. Okay. Okay. All right. So let's say everything looks good. Your credit score looks good. You have down payment. You're right. You have assets, right? For the down payment. And then your DTI is good as well. Other things that a borrower might also want to know: what else are they going to be paying for besides a down payment?
So you're going to be looking at, you're going to be making payments, like not a monthly payment, but I think that, like, and I'm not sure where you're going exactly, but from my perspective, and in the loan transaction, you're going to be looking to pay for your inspection, right? So usually the realtors will talk to you about inspecting the house, and when you go through an inspection, you're going to have to pay that up front. The same thing with the appraisal, right? In the lending process, we have the appraisal that needs to be done up front, and you're going to have to pay, usually you're going to have to pay the appraisal up front. And so those are things that you got to watch out for. Now the appraisal, right, most of the times, I would say probably like 80% of the times, it comes in and it's fine. But if you're in a market where all of a sudden the houses are appreciating dramatically or depreciating dramatically, or there's multiple offer scenarios where you're bidding over the asking price of the house, right? There's a possibility that appraisal might come in low, and that might affect your financing, right? So that's something that you have to consider when you're making offers on a home.
Right, right. Okay. Okay. Um, well, I was going towards closing costs as well. So,
Yeah.
Can you explain closing costs a little bit? How much can a borrower expect to pay for that?
Yeah, so usually I tell my borrowers somewhere between 4 to 4.5%, simply because taxes and insurance has gone up significantly. It used to be 3%, right? 3% usually used to cover everything. But here in the Twin Cities, anyways, I'm not sure about Milwaukee, but here in the Twin Cities, as well as in Florida and in California, we've seen insurance prices increase pretty significantly. Here in the Twin Cities, taxes also have increased pretty significantly. So to be on the safe side, I would probably suggest, estimating about 4.5% of the purchase price to be able to cover for some of those expenses when you're going to closing.
Okay. Okay. All right. So now we kind of know, how much how much everything is that's involved in buying a home, from the pre-approval process to the estimated costs, including down payment and closing, including inspection, appraisal, things like that. Um, let's say you got your pre-approval now as a borrower, right? As a buyer, you got your pre-approval letter from Johnny. Now you're ready to go shopping for a house with me as your real estate agent or whoever, right? Um, what happens after you get an accepted offer? What's the process like after that
Yeah, so on
on the
the
lending
real
side specifically?
yeah, okay. So on the lending side, um, what happens is you have to submit all updated documentation, right? Along with the purchase contract so that they can know which property it's located at. The loan officers are going to be looking at, the specific taxes for that property. We're going to ask you to go out there and get quotes from insurance agents. Unless, like for me, my team usually has one or two insurance agents that are assisting us and getting quotes back at a in a reasonable time frame. And so we'll have you guys, talk to them and reach out to those specific people. They usually turn back around and get insurance quotes within hours, right, of doing the transaction. So once we have the purchase contract, the insurance, the possible appraisal value, we'll order an appraisal. We're going to have to talk about interest rates, right? Where interest rates are at the current time. A lot of people, call in and they're like, "What's the interest rate? Can I get that interest rate?" And the honest truth is, if you're not under contract, we can't even lock you in yet. And so, we're going to be looking at what the interest rate's going to be looking like at the time that you are under contract. And sometimes, I'm going to be honest, you have clients that, turn around and they close in the same month. The interest rate is exactly what you originally quoted them. There are others where it took 2 years, right? And the interest rate is day and night different from the first time that they came back. That happened, when COVID dropped interest rate dramatically, and then we shifted the other direction. I had clients that were building new construction homes, and they came in thinking that their interest rate was going to be, 3.5%. And when they closed, it was like closer to like 7%. And so that's dramatically different. And you're looking at the payments are going to be dramatically different as well, right? Some people weren't able to afford it. And so they have to actually, try to sell their properties. But for those that could afford it, they went ahead and closed it. But the payment wasn't nearly what they thought it was going to be, right?
Right,
So
right.
there's challenges and difficulties in situations. And my thoughts are, once you sign the disclosures, after that, we'll get moving on obtaining everything else, such as, title work to make sure, um, the property is in the seller's name so they can actually sell it to you. We're going to be looking at waiting for the appraisal to come in to see what that looks like. The loan needs to be submitted to underwriting to double check all of the information that you provided us with at the beginning, as well as the updated docs like updated pay stubs, updated bank statements. Once we submit it all in, they'll ask, if the underwriter has questions, they'll ask for additional documentation. If there are no questions, then it's pretty simple, right? We get it in, wait for the appraisal, and then once the appraisal and the title comes in, and insurance is firm, and you selected the insurance agent that you want to go with, um, and we get everything clear to close, then we're good to go. And that, for people like us, Laura, we're both on the broker side, right? So we
Mhm.
move fairly fast. Like I think my average turn time is about 14 days to clear to close, and that's saying that's that. When I say my, I mean my whole entire team, right? My specific turn time is approximately, uh, I would say probably closer to like 7 days, where like a ton of them actually, get cleared closed in 4 days, which we move super fast. But if you're going to go to a local bank, it could be a full 30 days, possibly even 45 days, depending on what they have in the pipeline, right? Because they usually have uh, staff members for each position, and they take a little bit longer to get things done because they have more transactions going on. But with brokers like us, we move pretty fast. Usually in 14 days, you'll have a clear to close. If you don't, there's probably something going on that just isn't looking right. And we need to clarify that with the underwriters to get you to clear to close. So,
Right, right. Okay, so you said a lot of things there. Let
mhm.
me recap some of the important things that I heard, so that everybody else can also, hear it again and take notes. That so a lot of buyers, right, when they're calling, they're talking to loan officers in the beginning, right? What's the interest rate today, right? And you mentioned, well, technically, it doesn't really matter what the interest rate is today because we can't lock that in for you until you find a house and you get that accepted offer, right? And so you
Mhm.
said, and in all honesty, it could take a month, it could take a year, right?
Mhm.
And so the interest rate is going to change, right? So whatever we quoted you at the time of your pre-approval, it's not gonna be, it's not gonna be there potentially anymore, depending on how long it takes you to find a house. And then as far as the lock goes, right, until the point where we lock it in, can you talk about locking the rate in? When do you do that? When does the buyer do that?
Yeah, so that's within 3 days of receiving the purchase contract. We usually like to have that done.
Mhm,
But you do have the choice to float it, right?
mhm,
So you just have to have it done at least 3 days before you get that clear to close and before
okay,
closing.
mhm,
We have to, as lenders, we have federal regulation that requires us to get our clients closing disclosure at least 3 days before they're closing, right?
right,
So you don't want to wait until the last second. Usually if my clients that wants to float it does float it, um, then we do it about 2 weeks before closing. We lock in the rate.
right, right. Alright, so the important thing is you do have to lock it in order to get the clear to close.
Mhm.
Now, as far as the lock goes, there's a time frame that you can lock it, right? And usually
Mhm.
it's what, 30 days, 45 days, something like that, right?
Yep, yep,
Um,
30 to 45 days is pretty average. Once in like, if you're in, crazy market
mm,
times, right? Sometimes they allow you to go to 60, right? But
wow.
you don't see that very often.
Right. So what happens if the lock expires?
If their lock expires, there's fees involved, right? So you're gonna have to pay for extensions, and as far as like, it depends on, you can only extend so many times before the contract has to be canceled, and
Mm,
so you're gonna want to close as soon as possible.
right.
Um, the fees are going to be dependent on what rates look like at the time that you need to extend it, right? Let's say, for example, you get to a point where the interest rates are lower and you have to extend it. There might be a possibility to do a float down, but like, that has to be in a situation where the rates are going down by like 1%, right? For it to make sense. We've seen it in the past. It doesn't happen very often, but you can do a float down where you get a little bit of a better rate, and then the points from that new rate actually pays for the old extension fees that allows you to be able to reduce the rate. In most cases, if you don't extend, right, the interest rate will increase. And if it does increase, then now you're paying for a higher interest rate plus a fee. And it could be anywhere between, like, um, I would say 15 basis points all the way up to a percent, depending on what it is that you're trying to do at that time, whether you're trying to lock in for another 30 days, or just like a 15-day extension or a 5-day extension. Each extension is going to cost differently based on the length of time.
Got it. All right. So very important that you do have to use a lender that can actually close on time, right? Because if you locked your rate in, it expires. Now you're looking at potential extra fees in order to extend that. So it's something important to keep in mind, right? Like Johnny just mentioned,
Mhm.
his team, their clear to close turnaround time is around 14 days. That's freaking fast. Um, the typical real estate transaction normally is about 30 days. And if you can clear a whole loan to close within 14 days, 2 weeks, that's amazing, right? That's really good. And so that also goes along with the one of the reasons why I always tell like consumers that, hey, don't always chase the lowest rate, right? If you're always trying to shop for the lowest rate, quite honestly, a lot of lenders, they can promise, they can advertise the lowest rates, but is the customer service there? Can they close for you, right? If they can't do that, right, and it becomes a pain in the butt and a nightmare for you as a consumer for that whole experience, is it worth it, right? So,
Yeah, I've seen scenarios where someone would go and lock in somewhere else, right? Rather than, like, I think we're priced very fairly in the market, right? Probably even on the cheap side, right? So far, as far as I'm aware, we've beat out pretty much everyone, but there's a few lenders out there that are willing to lock a 15-day lock in, even though they know they need 30 days. And when they do that, there's going to be an extension fee, and they don't tell you that up front. But then in the middle of the process, you're going to be worried about the situation. They're going to be like, oh, we need to extend the lock, and now you got a fee you have to pay. And had you paid that with our company, you probably have a lower rate, right? So those are things that you got to consider. There are other companies that they promise a super low rate, and then they can't perform, right? um a while back, when I was with a different organization, um we were the wholesale division that we worked with. It was a specific lender out from the West Coast. um they would tell us that the rates are, super cheap, and then we would get them. Well, our clients would get locked into a contract. We would lock in the rate for 30 days, and it would take them 90 days to close the transaction. And some of those deals fell apart, and some of our clients lost a ton of money. I can tell you, we never used them again after that. And that was prior to me starting Win-Win Financial. And so like, and from that instance, I also learned that, hey, you gotta vet out all of your people, right? You gotta vet out your wholesale lenders and all the vendors that you're going to be using. So these days we have really, really strong vendors that we use, and we won't use anybody else, even if their price is cheaper.
right, right. Okay. So, let's talk about a little bit about the what goes on after you get your accepted offer, right? There's a couple more people involved now at this point, not just us as the loan officer, right? Um, Processors, what are their roles?
Yeah, so a processor, usually the processor receives the file, either okay, so there's different institutions have different roles for different people. So if there is a loan officer assistant involved, right? After you get the contract, they usually take over until it goes through underwriting. After underwriting, it usually goes to a processor. What a processor does is they get the list of items needed from the underwriters, and then they go out there and they obtain all of these documents, right? So they'll reach back out to you as the client for additional documentation that they might need from you, whether that be an updated pay stub, an updated bank statement, a letter of explanation, verification of employment, whatever the case is. They're the ones that are going to be reaching out back to you. In addition to that, they're also the one that's connecting with your insurance agent, the title company closer, right? And they're the ones that are trying to make sure that everything goes as smoothly as possible to get this clear to close. And then after that, after the clear to close, depending on the institution, it may go to a closer, and the closer then will take it from there run all the numbers, get with you, talk over the numbers, make sure the closing dates and times are in order with the title company so that everything can go smoothly at the closing table.
All right. So, processor is kind of like the assistant to the loan officer, right? So, helps to gather all the docs, make sure, especially if you had initially submitted, right? One of the common complaints that sometimes we get from borrowers, I've already submitted my bank statements when I did the pre-approval. Well, they don't realize that, hey, well, between that time and now when we're about to close, it could have been 3, 6 months, a year, right? We're going to need the new updated documents, right? So the latest monthly statement, right? The latest check stubs, right? All that stuff. So that's one of the things the processor helps out with. Now you mentioned our favorite person, the underwriter. Can you kind of talk about what what is the role of an underwriter, right? What do they do?
Yeah, so an underwriter is there to make sure all of the guidelines, federal regulations are followed, as well as appropriate calculations are done so that we're not putting, or lenders in general are not putting clients in a really bad situation, nor putting the lender themselves into a bad situation. Right, where the borrower can't pay, or where there might be a possibility where the loan itself is not something that should be lent to that specific individual. So they're looking at the whole entire portfolio, right? They're going to be looking at your credit, they're going to be looking at your income, they're going to be looking at your assets, they're going to be looking at the property documentation, they're going to be looking at the characteristics of the overall transaction. And say, for example, if someone comes in and they want to get a loan for $1 million, right? And they can only afford to buy a $300,000 house, the underwriter has to make that deciding factor that they're going to decline the loan because the likelihood of that individual making those payments just isn't there, or possibly the programs that the lender themselves have actually fits the individual. And if it doesn't fit their criterias of lending, then just because of the level of risk of that type of loan, and if the lender is not willing to accept those type of loans, then they're going to be the ones that are going to be declining the transaction. However, they're also the ones that approve transactions, right? And I think like 95% of loans get approved, assuming the loan officer did their jobs correctly, right? At the very beginning, the underwriters will work with them to try to figure something out to make sure that everything is correctly. But sometimes there is that challenge where they provide a list back and we may not know what to obtain exactly, right?
Mhm.
I mean, your loan officer should have an idea and should have some connections, but I can definitely say that when I first started in this business, I ran across a situation where I was a processor, have never done manufactured homes before, was very little had very little experience. The underwriter conditioned for an engineer cert for the manufactured home. I had no idea where to go get it. The client had no idea where to go get it. It was a cash out refinance, so there was no loan officer technically involved because we had the institution that I was with had a centralized system where all you do is call a number and um, they'll fill out the application and send it over to the processor, and the processor is supposed to figure it all out. Well, if you're in a call center in, the Twin Cities here, and the property is out in Arizona, and you need engineer cert, you're not going to know what to do to be able to have that happen. So, um, it there's things like that that comes up that you got to watch out for. Underwriters also pay attention to those kind of things. They'll know what to look for, and usually when you have conversations with them, they'll be able to tell you what is acceptable or not acceptable.
Mhm.
So there's a lot that underwriters do, and a lot of people just thinks that the underwriters ask for too much documentation and that they they ask for ridiculous things like your fingerprints and so on. But there's a reason for it, right?
Oh yeah, yeah. So it's a lot of fun with underwriters, but basically to recap, underwriter's main job is to qualify the borrower, right? Make sure that they can afford to pay the home, the loan product type that they're using is accurate, that their income is legit, right? one of the biggest things is, they want to make sure that, you're not committing any type of money fraud type of thing, right? Right, where you're illegally causing some kind of mortgage fraud, right? So they want to make sure that you're buying the home for the right reasons, right? And your income's legit. But then the other thing they check is the property, right? They want to make sure the property is also a good quality home that the lender is willing to take their money and put a loan on, right? So that's the things that they're watching out for. And yes, underwriter is going to ask for a certain number of things. It's going to be kind of crazy. All depends on how complicated of a borrower profile you have as well. Meaning, if you own a lot of assets, you own a lot of businesses, right? Your profile is very complicated. It could be a ton of questions that you have to be prepared for, right? So, did you used to be underwriter as well?
Yeah, yeah. So I was I think most of my career in mortgage, I was an underwriter,
Oh,
and then eventually, like I said, I had I was the supervisor of the wealth management underwriting team at U.S. Bank before I left the banking world.
right, right. So that's why I ask you all the questions. Like, hey, this
I have I have sympathy for underwriters, man.
we don't like underwriters. We don't like underwriters. No, but they serve a purpose, right?
Yeah,
A lot of us agents, professionals, real estate professionals, it's underwriters can sink a deal, right?
yeah.
But they serve a purpose. They're put in there for QC, right? Quality control, right? They want to
Mhm,
make sure everything's
mhm.
legit. And so it's required, guys. So if they're gonna ask you for CPA letters, taxes, things like that, P&Ls, just do it, right? And that's the one other thing that that will determine whether you're going to get the clear to close quickly or not, is that how fast you respond to the requests from the underwriter, right? If you
Absolutely.
if you take a couple of days to get some documents back to them, then it's going to take them more time to wait for those documents and then review. And then they could either, if they see something in those documents that they're like, oh, you introduced new information to me, right, that I didn't know before. Let me find out what is this property that all of a sudden you also own, right? um well, why was that not disclosed earlier, right? So now they're going to start asking more questions. So a lot of times, as a borrower, right, you should disclose as much as that you know that you're going to be using, right? If you're using business account funds for your closing, right, you you should tell the underwriter that where those funds are coming from, and they're going to ask you about your business account. They're going to ask you information about that. What type of business, right? Do you own 100% of that, right? All these other questions that might pop up, right? So we as your loan professional, we need to know that type of stuff so that we're prepared. We can advise you appropriately to make this a smooth transaction. So, anything I miss on that?
Yeah, I don't think you missed anything. I think you covered pretty much everything. The only thing that I would suggest is don't hide stuff from your loan officers, right? If you're hiding stuff from your loan officers, the underwriter will find it. It's just if you decide to go get a credit card, there's like trigger stuff that will automatically come out to the underwriters to say, hey, this guy just, picked up a new car, a new
Hmm.
sofa, or whatever the case is. And if you're at max debt to income ratio already, that might just throw you overboard, which means either you have to return the item or you're not closing, right? So,
Yep, yep. Very important, very important. Yeah, I mean, anything you do while you're in the transaction, it's going to show up in your credit report, and you better believe right before closing, they're going to check your credit again, right?
mhm,
So
mhm.
it's happened before where I mean, not to me, thankfully, not yet, but we always tell our borrowers, hey, don't open up any new loans, don't buy a car. Just wait till closing, okay? The appliances, the furniture, don't go take out a loan on it, okay?
Yeah,
Right. So
yeah.
yeah,
Even
yeah,
if
very
it's a zero payment, even if it's a zero payment loan, do not go take it out.
yes, yes, because they're gonna ask you questions. Well, what is that about, right? So yeah, don't do that stuff. Um, but I think that is pretty much it. And then once you get the clear to close, you as a borrower will go to the closing table, sign your closing papers, your deed, right? Congratulations, you own a house. Of course, you have to bring your down payment, right? Usually wire funds or a check, depends, right, on what the title company wants. But that is pretty much the loan process on how to buy a house. So if you have any questions at all, feel free to drop it in the chat here while we're here. Or if you're watching us on the replay, go ahead and still drop the question in and we'll respond to it later after this. So that's pretty much what we wanted to cover today. Anything else that you want to talk about, Johnny, before we head out?
Nah, I guess if you're looking, happy house hunting. Feel free to reach out if you have questions. If you're looking in the Twin Cities, hey, we'd love to help you. Right. So that's all I got.
Yes. So, but you service more than Twin Cities, right? So you've got license, your lending licenses in what, Florida, Minnesota?
Just Florida and Minnesota. Yeah.
Florida,
So
Minnesota.
yeah. So if you're looking out in Florida, we'd love to help you too.
Right. So, I myself, shameless plug, licensed in as a loan officer in Wisconsin, Minnesota, and California. I'm working in some other states as well, but haven't taken the courses yet. But then on the real estate side, Johnny and I are both real estate agents as well. Minnesota for Johnny and Wisconsin for me. But we also are part of a very big network. We have 28 other agents in our direct network all across the U.S., 10 plus cities, and 5 different states right now. But with our network at EXP, we have about almost 90,000 agents worldwide. US, Canada, Mexico, 28, 30, almost other countries, right? We can help you out. So wherever you need your help with real estate, let us know. All right, Johnny, thanks for being here and willing to share all that knowledge that you got. If anybody has questions, feel free to reach out to Johnny. You're blocking is that your phone number behind you?
No, that's just
MLS
that's just
number.
my
Okay.
MLS
But
number.
if you want to share your contact information real quick, in case anybody has questions they want to reach out to you.
Yeah. So you can just go on my website. It's a win-win. So WIN, right? Financial.com. And you should be able to schedule a call with me there. Otherwise, you can reach out to me at johnny@winwinfinancial.com.
Okay, awesome. And then as for me, my contact, I mean, if you're watching this live, you have my socials. You're watching this on YouTube, check my YouTube channel. So feel free to reach out. We'll see you guys next time.